In this session, we will try to understand the various quantitative methods that are available for measuring the default risk. Initially, I will talk about structural based models. Structural based models typically the most common form of that structural based models is a Merton model. So we'll try to discuss a little bit more on this Merton model. Then we talk about a brief into the credit scoring kind of models, and then we try to understand the various the various classification mechanisms. How do various models classify a particular firm into default or non-default kind of category? What are the various mechanisms that are being used in those things? And finally, trying to understand some of the trade-offs and what are the various factors that we consider in the choice of the model. So these are some of the things. Of course, not too much of numerical calculations involved in them, but trying to understand the quantitative methodologies that are available for the computation of the default risk. So let's get started. The first of them is the structural based models. When I talk about the structural, they look at the structure of the balance sheet. They look at the capital structure. Based on the capital structure of the firm, means based on the debt as well as the equity structure of the firm, they try to compute the probability of default. Though that's the reason they are called as structural models. Based on the understanding of the value of debt and the value of equity of the firm, which combined together will form the value of the firm, based on them they are used to compute the probability of default, because default is more associated with the inability to pay the interest and principal on debt. So based on this value of debt, or probably what proportion of the overall value of the firm is the debt, so based on those kind of aspects, the probability of default is computed. And if we understand a little bit more in detail, whatever is the value of the firm, right? If it means that probably if the firm is getting liquidated, this is the amount that the firm will fetch. If it has to sell off, this is the amount that it will fetch, out of which the value of debt, the debt is the amount which the lenders, whatever the amount they have lent, they would be taking that, and whatever is the remaining amount, that would be going to the equity investors. So let's say if the value of the firm is $100 million, and probably the loan that has been taken is to the extent of 80 million, so then the remaining 20 million goes to the equity investors. But in the same example, if the value of the firm came out to 70 million, then the debt investors will take only 70 million and the equity guys will get zero, because equity has the last claim on the value of the assets, and the debt investors typically have a fixed claim. So unless the value of the firm, if the value of the firm goes lesser than the value of the debt investors will get all the value of the firm and the equity investors will get nothing out of it. Means though they have to get 80, but because the value of the firm is only 70, they are going to get only 70, means they are absorbing a loss of 10 million. But in case the value of the firm is higher than the value of the debt, obviously they are still going to get their value of 80 million itself, means the remaining 20 million will go to the equity investor. So here we are seeing that the payment to the equity investors is more like a contingent claim and somehow resembling a call option position. If we just evaluate this or look at it a bit more in critical, this is suggesting a call option position on the firm, the call option on the value of the firm with a strike price equal to value of debt. When I look at the payment to the equity investor, it looks as if, see, if the value of the firm is less than the value of the debt, the equity investor is going to get 0. If the value of the firm is greater than the value of the debt, he is going to get the difference. This is exactly similar to the payoff on a long call option. So a long call option on the value of the firm with a strike price equal to value of the debt is what is the payment to the equity investor. So equity investor will receive the maximum of value of the firm minus the value of the debt or 0. If the value of the firm is greater than the value of the debt, he is going to get the difference, and if the value of the firm is less than the value of the debt, he is going to get 0. So it can very well be modeled as a long call option on the value of the firm with a strike price equal to value of the debt. That is what we talk about the equity investors payment. Whereas look at the debt investor, what is he getting? If the value of the firm is lesser than the value of the debt, he is getting the value of the firm, and if the value of the firm is greater than the value of the debt, he is getting value of the debt. So the minimum of those two is what he is getting. Or in another way, I can look at it as he is getting a risk-free rate of return, which is 80 million, or he is getting his debt, value of debt, which is 80 million, plus or probably minus the maximum of value of debt minus the value of firm, comma 0. Means he will receive a loss to the extent of by how much the value of debt is lesser greater than the value of the firm. To that extent he is taking a loss, which means it's as good as he is having the value of debt which is a risk free bond, because here, one thing which I missed out, this model assumes that the whole debt of the bond, the whole debt of the firm is a single zero coupon bond with a face value equal to the value of the debt. So the whole debt of the bond is being looked at as, or the whole debt of the firm is being looked at as the bond, zero coupon bond with a maturity, the T period. So when I say value of debt, it's having a risk-free zero coupon bond, and at the same time it has a short put position. When will the short put position gain? In case of a short put position, if the value of the firm is greater than the value of the debt, there is no loss. But if the value of the firm is lesser than the value of the debt, there is a loss incurred because the buyer of the put, the long put will exercise the put when the value of the asset is lesser than the strike price. So because of that exercise, the seller of the put is going to incur a loss, and that is what this position is, a short put position. So we are talking about a risk-free bond plus a short put position as the payment to the debt investor. So because we can very well look out for the option related representation both for an equity investor's payment and a debt investor's payment, we can very well use the option pricing methodologies like Black-Scholes option pricing formula. We can use option pricing methodologies to evaluate the payment to the equity investor. So let's look at that. We said the price of the call option is, as per the Black-Scholes model, the price of the call option is nothing but the S into ND1, the spot price, times ND1 minus X e power minus RT times ND2. And out of which we said D1 is nothing but log S by X plus R plus sigma squared by 2 into T divided by sigma root T, and D2 is D1 minus sigma root T. This is what we talk about the Black-Scholes model for finding out the price of the option. So here the S is nothing but the value of the firm. Now if I need the value of the firm, I require the value of equity plus value of debt. The problem comes when I have to find out the value of the debt, especially for long-term borrowings. It may be very much possible that the value of the debt may not be feasible at all. I mean, getting the mark-to-market values of the debt is difficult because that debt, that loan may not be traded on a day-to-day basis. That's one challenge, though I can use the Black-Scholes based formula. Okay, X is the strike price, which is nothing but the value of the debt. R is the risk-free rate of return. Sigma. Sigma is the volatility associated with the asset value, which is again a very difficult thing to estimate. Coming out with an estimate of the volatility of the asset value is a difficult thing. So because of these three reasons, whatever the assumption that we have made, and this entire mechanism will work appropriately only when I see that the firm value, the value of the firm follows a log normal kind of a distribution only, because the basic assumption of the Black-Scholes formula model is the prices follow a log normal distribution. So instead of stock price, here we are looking at the value of the firm. So the same assumption will still continue. I will assume that the stock with the value of the firm follows a log normal distribution. So only when that assumption is fine, and at the same time I don't see any intermediate withdrawals from the bondholders. Why should I think of this? Because whatever the Black-Scholes formula is applicable only to a European call or a European put option. European is always the exercise on the last day of the maturity. So here also we are looking at the bond that is being withdrawn or redeemed only on the last day of maturity, means no intermediate withdrawals or no intermediate forceful bankruptcies kind of scenarios getting into the process. So only under those assumptions being met, we can very well use the Merton model, which assumes the equity as a long call option on the value of the firm with a strike price equivalent to the value of the debt. So this mechanism is very comfortable in terms of assessing the probability of default. In this we would see in general that n of minus d2 is what is generally considered as the probability of default. That is how we link the option pricing formula to the probability of default. Alright. Now, the next thing we are going to look at here is the credit scoring model. They are generally applicable for individuals and very small size firms, whereas the Merton based model which we discussed earlier, the structural kind of models, they are applicable typically to large firms whose debt is actively traded and where the equity of them is widely traded. So those kind of firms, it is better to go with uh, the structural models like Merton model. But for very small private firms and individuals, the credit scoring models are more appropriate. And in the credit scoring models, what we see is based on the various characteristics of the borrower, the scoring agency or a rating agency, they compute a score based on some formula. They compute a score, and that score is in turn used to compute the probability of default. That score is generally used to compute the probability of default. And as a benefit, every small organization as well as every individual wants to get a credit score for themselves so that they can make the borrowing process more easier and probably at a more comfortable and convenient rates. Because if I get a rating for myself, it may so happen that I can demand the bank or I can request the bank for a much lesser interest rate on the loan, and probably I can get a loan that is potential to my capability to repay. So any scoring model that is generally developed, it should be accurate enough, means the error should be much lesser. Probably in terms of classifying, a good credit person needs to be classified under the good credit only. He should get a very good credit score, whereas a poor credit person, he should get a very low credit score kind of thing. So very few misclassifications should occur. Misclassifications should be very low. That is one of the key attributes of a credit scoring model. Then it should not consider too many independent variables because they are difficult to gather. Right? If I have 10 independent variables, probably data collection corresponding to those 10 independent variables will become very difficult. So there should be a parsimony associated with the model. It should not, whatever the score that it is arriving at, probably with a very few easy to collect kind of variables, it should be able to compute them. And whatever the outcome that it is computing, it should be very much closer to reality. It should not be a vague kind of outcomes. It should be more and more appropriate to the real world. And of course, to arrive at it, the cost that is incurred, either in terms of resources used or in terms of time that is used, it should be pretty much limited. And the whatever the output that it is producing, it should produce the output quite quickly, because the credit characteristics will keep changing over time. So the response that is coming out, it should be given in very quick amount of time. And finally, whatever the score that it is generating, it should be the calculation process or the scoring process should be very much appropriate and transparent, and even the output that is coming out should be quite comfortably interpretable, easy to interpret. Greater than this number means it's a good credit individual or a firm, or less than a particular number means a poor credit score. Something like that should come out, very which is easy to interpret, which also forms one key aspect or one key quality of any credit scoring model. Then, what are the typical methodologies? See, basically, once I have a large volume of data or different sets of firms with different characteristics, my job is more to group them or classify them, probably into potential default kind of companies versus non-default kind of companies, or basically create a differentiation or create grouping among those individual firms, and classify them that these are going to be risky and these are going to be non-risky. So in that process, we have different methodologies that are associated for the scoring. Some of the common mechanisms that are discussed in that are the linear discriminant analysis, which is proposed by Fisher. What it does is, okay, this is my data, this is the set of values that I have, this is the set of companies for whom I have taken the various characteristics which I thought would help in deciding whether it would be defaulting or not. Now, just group this data into various subgroups. And these subgroups will have homogeneous properties, because probably it might be like this group, I may call them as no default, and this group I may call them as default. There will be clear-cut differences existing between these two groups, whereas within each of the group there could be a lot of homogeneity that is. So based on the characteristics, some scores are attained, and based on the scores we will differentiate. If it is greater than something, then you may say that this will fall into a default category. Less than something, it will fall into a non-default category. So it's a kind of discriminating the data and classifying that into a default versus a non-default kind of a category happens in linear discriminant analysis. Whereas on the other side, I have another mechanism called parametric discrimination, a slight better extension to this discriminant analysis. Apart from just doing the grouping, we also use a score function, probably a logistic regression model, or a logit or a probit kind of statistical models can be used to find a score. It's not a predetermined kind of a score based on a formula. See, in case of the linear discriminant analysis, it may so come out that we set a benchmark for the score, and anything above it we say default, below it we may say non-default, like your Altman Z-score model, which says if the Z-score is greater than 3 based on some predefined formula, if the Z-score comes greater than 3, we say it is not default kind of a firm, less than 1.8, the chances of default are much higher, and Z score between 1.8 and 3, a kind of alarming zone. Whereas when we talk about a parametric distribution, we are using the mean and the variance of the various characteristics, and then building a kind of a regression model, trying to map the default firms with the non-default firms, and then try to arrive at a score, generally a probability score which can lie between 0 and 1. So we can very well do the grouping like if any value is less than zero point 0.5, if the score comes out to be less than 0.5, we may push it towards a group 0, greater than 0.5, we may push it towards a group 1, which means this may be classified as non-default and this may be classified as default. So we are not coming out with a predetermined formula here. We are trying to derive the formula from the existing data set itself, and based on that trying to find out a score, and based on the score that is determined we will try to group it into a default or a non-default kind of a characteristic. So this is purely a parametric, using some parameters, the mean and the variance of the various characteristics, we try to group the firms into default versus non-default kind of categories. And then the third approach that we look at for classification is the nearest neighbor approach. It's a pure non-parametric kind of approach. Okay, I see that these are the firms that are under the non-default category, and these are the firms that are there in the default category. Now I have a new firm which is having properties 1, 2, 3, 4, characteristics 1, 2, 3, 4, 5. Now I'll check out, okay, this characteristic 1, is it more closer to this category or more closer to this category? Similarly, characteristic 2, where is it more closer to? Characteristic 3, where is it more closer to? Based on the assessment of the various characteristics, I will see whether each of these characteristics are more and more closer to a non-default category or a default category. I will try to see how many nearest neighbors are there. When I say nearest neighbor, in how many characteristics this is nearest to this, in how many characteristics this is nearest to this. So the higher the nearest neighbors that I am having, this particular firm will be pushed into that appropriate category. So the more and more proximity of the group with respect to various characteristics, we are trying to classify the firm into those groups. That is what goes as a k nearest neighbor approach. Remember, this is a non-parametric approach, no computations of the means and the variances, whereas the parametric discriminant approach is purely based on the means and the standard deviations and then fitting a regression model and then doing the classification. Whereas the final mechanism that is generally used is the support vector machines, which is again an extension to the discriminant analysis, where the discriminant analysis is more linear in nature, whereas the support vector mechanics can be created even with a non-linear kind of an equation. Finally, we are trying to design an equation which can be used to simply divide the data into multiple subgroups. That is what is the support vector machines mechanism, where the Fisher linear discriminant analysis may be only applicable with respect to the linear discriminant, whereas a linear equation to differentiate, whereas when we are talking about support vector machines, it could even be a non-linear approach, It could even involve a three-dimensional planes kind of equations. The division can be on multiple bases, but finally the one which classifies more, which provides the classification with the least amount of error is what needs to be looked at as a part of the support vector machines mechanism. Then in each of them, whatever is the mechanism that I am using, I have a decision rule. What do I say? What do I mean by a decision rule? How do I classify this particular company or this particular firm into default or non-default kind of a category? On what basis I look out for which group is appropriate for this particular data, for this particular security, for this particular asset? That is what we call as a decision rules. Again, there are different types of decision rules that we talk about. One is a minimum error decision rule, which uses the Bayes theorem. It's nothing but it looks at, for each of the groups, it looks at, based on the characteristics, what is the chance that it will be associated, what is the chance that it will be associated to a default group, multiply it with the probability of default. Similarly, what is the chance that it will be allocated to non-default group, multiply it by probability of non-default. Similarly, if there are some other probability that it will be classified to a neutral group, multiplied by probability of neutrality. I can look at the various groups, the probability of it being classified to that particular group, because default group means it has some characteristics. So, assuming that this is a default group, right, assuming that I'm looking at purely a default group, what is the chance that this particular security or this particular asset can default? So I will look out based on the characteristics of that particular asset. I will look out for the conditional probability that it will fall into that particular category, and based on that try to assess for which of these categories the probability, conditional probability is much higher, and the allocation will happen to that particular category. So it is purely based on the calculated probabilities of the asset falling into that relevant group based on the characteristics of that particular group and the characteristics of the asset that we are considering for classification. That is the minimum error mechanism. It is purely based on the calculated probabilities. Whereas the other three mechanisms that I am going to discuss now, they are purely based on the optimization techniques to minimize the probability of wrong classification or to minimize the probability of error. There is a minimum risk mechanism whose objective is minimize to whatever extent, try to minimize the probability or severity of the misclassification. Classify the values in such a way, arrive at a decision criteria in such a way that the probability of the misclassification or the severity of the loss of the misclassification is going to be much lesser. Whereas we have a Neyman-Pearson based decision rule, which is using the statistical errors, the type 1 and type 2 errors. Type 1 error I am defining as, type 1 error rejecting a true null hypothesis, right? So lending to a risky firm. We know that this firm is risky, for which the loan should not be given, but I am ending up giving a loan to that firm. That's a type 1 error. Whereas when it type 2 error, we talk about the failure to reject the null. Failure to reject the null when it has to be rejected means a non-risky firm, we are not lending to that firm. So we are talking about these two types of errors, and the intention is work with the type 2 error, predetermine the type 2 error, and based on that you decide a threshold for the probability which will make you attain that type 2 error with a very little amount of type 1 error, and based on that the groupings are done. That is what is the Neyman-Pearson criteria. Whereas when I talk about the minimax criteria, the objective is to minimize both type 1 as well as the type 2, which means the maximum of those two, whichever is type 1 or type 2, the maximum of those two I have to minimize, and that can happen only when both type 1 and type 2 errors are equal. So we will try to decide that kind of a rule, that kind of a probability where the type so the probability is not decided from the values, from the outcome. Okay, if I choose this particular probability as the cutoff point, anything below this I will classify into default, anything above it I will classify into non-default, and that probability is being decided in such a way that there is a minimum type 1 and type 2 error in the process. So different mechanisms, let's say we are talking about the linear discriminant analysis mechanism, it will use the minimum error approach. Like that, the various different mechanisms that we talked about here, they may use the different decision rules as a part of classification of a particular asset into the different categories. Now, out of the various such models that we have, obviously they are exposed more and more to sampling errors because we are working with the samples, and there could be always a difference between the parameter values and the sample values, which is getting exposed to sample errors. The way the inputs or the characteristics are computed, probably when I'm using the financial statements to compute some financial ratios, each ratio has 2 or 3 different ways of getting computed. So the mechanisms that are used for using our input itself could be very much different. So our problems can very much exist with the models which we are using also. And it also looks like there is a trade-off between complexity versus performance. While we all can agree that highly complex model, we generally believe that it is more robust, it gives a very high performance, but at the same time there is a drawback to that highly complex model. It consumes time, it consumes resources, it's a cost incurring, and finally probably it may be difficult to understand and interpret also. So I have to really take a trade-off between whether I'm looking out for a highly complex model which is huge time consuming and cost consuming, or an okay kind of a model which can result in decent outcomes which may not be very highly performance oriented. Then the other dimension I have to look out for is data availability versus data quality. So much of data might be available. The default rates of various customers over various years might be available with me. But what I want to know is what is the relevance of that particular data. Probably a 10-year back default data, is it relevant to the current scenario? What was the economic situation in the country at that point in time versus now? All these things have to be evaluated, and a trade-off between data availability versus data quality needs to be looked at. And as I have mentioned, accuracy versus time. Sometimes we may prefer more and more accurate model, whereas sometimes I may be more interested in something which can be done quite quickly, because I need both of them. I need accurate and time. But if I want extraordinary accuracy, I may have to compromise on time. If I want to have something very quick, I may have to compromise on the accuracy. So that is where a trade-off is very much required in terms of the choice of the model. But in general, if I have to look out for the various factors to consider while choosing a model, some of the most common things, there should be a lot of robustness. Even if I am applying it to a new data, it should reflect the reality, right? I mean the data which has been used to model the to create the model, I should have tested it out on the data which is not used to create the model, and if the robustness exists with respect to that, which means even the new data I am considering, my the model prediction that whatever is coming out, it is more and more robust. It should be easy to interpret and it should be easy to use. The time it takes for recalculations and the initial calculation should not be too high, because the outcome should be given as early as possible, because the risk characteristics of the asset keep changing with time. But apart from that, these two things are really interesting. One is the ROC, the receiver operating characteristic. Basically like this, you look out for the firms that are correctly classified as default. Means you identify number of defaults, right? Total defaults, out of which how many of them are predicted as defaults, right? How many of them are predicted as defaults out of those companies which have really defaulted. Means this is a measure of a correctly classified defaults, which is generally represented on the y-axis, and I take one more variable called number of non-defaults. Number of non-default means those firms which have not defaulted, and I would also look out for the percentage of firms that are predicted to default but did not default. The number of firms that are predicted to default but they did not default. Out of the total non-defaulted firms, you look at it like this. Out of the total non-defaulted firms, how many of them did your model predict that they will default? So this is a mechanism of incorrect classification of default. So let's assume that on this line, on the x-axis, I will take out of the total non-defaults, how many of them are predicted as default, right? This is the ratio I will take on the x-axis. Let's assume that it is 20%. So I'll take the point here, and on the y-axis I'll take out of the total defaulting firms, how many of them have really defaulted. Let's say around 75%. So it would be somewhere here. So the necessary point of x and y is somewhere here. Now I'll try to draw a line from the origin to this. This is the slope of the line. So the higher is the slope, the lesser is the error, and the better is the classification. Right? The lesser is the error, the better is the classification. And probably if I get completely vertical, means on the x value is 0, out of the total firms which are non-defaulted, none of them is predicted by the model that it will default. So that is where the 0 will lie, and the y will be more or less 1, because the maximum value for both of them can be 1 itself. So which would result in slope to be infinite. So the more closer to infinite is our slope, overall the worthiness of the model or the betterment of the model comes out. So it's a very interesting aspect, ROC. But the only drawback is it does not consider each firm separately. It looks at the total number of firms, how many of them are correctly classified versus how many of them are wrongly classified, and based on them it is a single line which will give me the accuracy or the goodness of the model. Whereas on the other side, I also have another calculation aspect called cumulative accuracy profile, wherein this deals with each and every firm. Okay, how I look at it is, let's say I have 10 firms, right? Let's say I have 10 firms. I'll try to find the probability of default for each of the firm based on the model, and I will, based on the actual default, I will do the ranking for each of those firms. So I will take the probability of default on x-axis, and the ranks I'll take based on the actual default, the ranks I take on the y-axis. So I keep plotting all the points and I generate a line. So the accuracy of the line, the direction of the line gives me the accuracy of the mechanism. The more and more all the points are aligned to the line, we see that the model is more and more accurate. Otherwise, there is a question with the accuracy of the model. So the shape of the line gives the accuracy associated with the model. So the advantage is, at least it considers all the firms together, rather all the firms individually, rather than computing only the total numbers. So on that dimension, I see cumulative accuracy profile a better measure compared to the receiver operating characteristics model. Alright. So this is what is a very brief introduction to the quantitative methodologies that are used to measure the default risk. If you have any further queries regarding the same, you can get in touch with me by giving me a call on the number that I have provided below, or you can even send in an email at vamsidhar@basegurus.com. Thanks a lot for listening to this session. Thank you very much.